Usually when we talk about valuing a media company, there's this implicit expectation of, geographical boundaries.
Right.
Like a traditional real estate map of the world.
Yeah, exactly.
Historically, you've got Hollywood dominating the West and Bollywood commanding the Indian subcontinent.
Bollywood in Nigeria.
Right.
Yeah.
And you just kind of operate under the assumption that everyone stays in their lane.
Yeah, that legacy mindset really relies on regionalization.
Exactly. The legacy model dictates that you build your content for your domestic audience first, and then whatever works, you just export the leftovers to the margins.
Right, because it treats global audiences as an afterthought, like an ancillary revenue stream rather than a core target demographic from day one.
Comfortably siloed. I mean, we like markets to be neatly categorized because it makes the financial modeling easier.
Oh, absolutely.
And quite frankly, it requires less cultural nuance from the studios.
Yeah.
But then, you look at the collision of AI-generated content tools and borderless global streaming, and suddenly that old real estate map is completely obsolete.
Yeah, it really is.
We're looking at an entertainment landscape that is dissolving its borders in real time.
It's a massive shift.
It is. So welcome everyone to a special Talk Tickers edition of The Deep Dives.
Glad to be here.
Our mission today is to decode the Q1 2026 earnings conference call for the ticker iQIYI. That's iQIYI.
Right.
And out of respect for your time, we are going to hit the 4 most critical takeaways.
Right.
The data, the story, the guidance, and the bottom line in under 5 minutes.
Sounds good. And, for anyone tracking the markets over the last decade, the narrative surrounding this company has been remarkably stubborn.
Oh, yeah.
Financial analysts have heavily relied on a very specific shorthand label for them.
Netflix of China.
Exactly.
It's everywhere in the analyst notes.
Right.
But diving into the actual transcript of this Q1 call, that label feels wildly outdated.
Yeah, it's a lazy comparison at this point.
It really is. What iQIYI is actually doing, what the data shows they are doing, is rapidly morphing into an AI-powered global content factory.
Right.
They are exporting culture at a scale that challenges the foundational assumptions of how international media distribution even works.
We are observing a complete metamorphosis here. They're transitioning from a regional platform attempting to mimic Western streaming models into a decentralized, technology-driven studio that operates on fundamentally different unit economics.
So let's start by unpacking the actual data from the transcript.
Let's do it.
Because the numbers tell a complex, almost contradictory story on the surface.
You really do.
Total revenue for iQIYI in Q1 clocked in at 6.2 billion RMB.
Right.
Sequentially, that is actually an 8% drop.
Yeah, an 8% drop.
And the main drags on that revenue were advertising, coming in at 1.2 billion RMB, which is down 8% sequentially.
Right.
And content distribution, which brought in 360.7 million RMB.
And that's the big one.
Yeah. That specific line item, content distribution, took a massive 54% sequential nosedive.
Yeah, a 54% drop in content distribution is the kind of metric that typically triggers a panic sell-off among retail investors.
Absolutely.
When a revenue stream gets cut in half quarter over quarter, the immediate assumption is just, a failure of the product in the open market.
It jumps right off the page as a massive red flag.
Right.
Wait, a 54% sequential drop isn't just a pivot? That looks like walking away from guaranteed cash.
It does. In the current economic environment, abandoning a revenue stream seems reckless.
Yeah.
But there is a crucial offset here.
Right. The membership numbers.
Exactly. Membership services revenue hit 4.2 billion RMB.
Which is an increase.
Yes, a 2% sequential increase. So their core subscription product is actually growing while everything else shrinks.
And the translation of those moving parts is really essential for you as an investor to understand.
Right.
Wall Street gets hyper-focused on top-line misses.
Oh, always. But the reality of that 8% overall revenue drop is that it resulted in a non-GAAP operating loss of 149 million RMB.
Okay.
That puts their operating margin at roughly negative 2%.
I have to challenge the strategy here, though.
Sure.
Negative 2% margin is still a loss.
Right. It is.
If you are an investor looking at a media company and they are intentionally letting their distribution revenue plummet by 54% to the point where they're operating in the red, How do you justify that?
Oh, you have to look at it.
I mean, it feels like owning a highly successful bakery and suddenly you stop selling your pastries to the local cafes that rely on you.
Right.
Taking a massive hit to your wholesale revenue, just hoping those cafe customers will eventually walk across town to buy directly from your flagship store.
That's a great analogy.
Is that a calculated moat or just terrible cash flow management?
The flagship store comparison highlights the exact mechanism at play here.
Okay.
To evaluate if it's terrible management or a calculated moat, we have to look at the intention behind the numbers.
Right.
Content distribution revenue, in this context, means sublicensing your original premium shows to competing networks or secondary platforms.
Oh, I see. So they are actively choosing not to give their competitors access to their best material.
Exactly. They are starving the competition of their intellectual property.
Wow.
If a viewer wants to watch a premium iQIYI original, they can no longer find it licensed out to a third-party broadcaster.
Right.
They must enter iQIYI's proprietary ecosystem.
They have to come to the flagship store.
Precisely. They are absorbing a short-term hit to their cash flow, that 54% plunge in wholesale licensing to build a high-value, long-term subscriber base.
Okay, that makes sense.
The 4.2 billion RMB in membership revenue is the direct result of hoarding their own IP.
Right.
So the 149 million RMB operating loss isn't a sign of operational failure.
It's an investment.
Yes, it represents aggressive, front-loaded investment into their proprietary channels and the technology required to scale them.
And the scale of that proprietary channel becomes the most compelling part of this earnings call when you look at the geographic data.
Oh, the overseas numbers are wild.
Yeah, because the conventional wisdom is that Chinese media platforms struggle to find audiences outside of their domestic market or the immediate diaspora.
Right, that's always been the assumption.
Yet the numbers reported here contradict that entirely.
Completely.
Southeast Asia membership revenue is up 40% year over year.
Yep.
Indonesia alone is up over 80%.
Wow.
And then you look at the other side of the planet. Markets like Brazil and Mexico surged by over 100%.
Yeah, that over 100% year-over-year growth in Latin America completely reframes their addressable market.
It really does.
It proves the cultural export is viable across massive distances.
But are we sure a 100% growth rate in a market like Brazil isn't just, a temporary novelty bump?
Well, that's the question.
A streaming platform can buy market share for a quarter with aggressive discounting or one viral hit. But sustained hypergrowth in a market with deep, entrenched domestic media, like Brazil's massive telenovela industry, requires a structural advantage.
Absolutely.
So how is a Chinese streaming service doubling its user base in Latin America?
The transcript specifically points to their content engine as the catalyst, specifically what they refer to as C-dramas or Chinese dramas.
Right.
They are not attempting to out-Hollywood the Western studios.
Right.
The traditional Western model relies on the four-quadrant blockbuster, right? Creating a piece of media so generic and broadly appealing that it captures everyone from an 8-year-old child to an 80-year-old grandparent.
Yeah, they're spending hundreds of millions of dollars trying to make sure nobody is alienated.
Exactly.
Which often means nobody is passionately engaged.
That's spot on.
Right.
By contrast, iQIYI is hyper-targeting.
Go.
They are leveraging C-dramas, sweeping historical epics, martial arts fantasies known as wuxia, and highly stylized modern romances.
Right.
These genres over-index dramatically with young female demographics.
Dude.
They have identified a global audience that feels underserved by the cynical, anti-hero-driven narratives dominating Western prestige television.
So it is a genre play.
Yes.
A show like Pursuit of Jade or How Dare You leans heavily into earnest romance, high-stakes court intrigue, and elaborate costume design.
Exactly.
The human emotions driving those plots, suspense, betrayal, romance, do not have language barriers.
They really don't, especially when combined with modern localization tools.
Right.
The barrier to entry for foreign content used to be the friction of poor subtitling or the immense cost of professional dubbing.
Yeah, it was too expensive.
But as those costs plummet, the underlying emotional resonance of the C-drama format maps perfectly onto regions that already have a rich tradition of serialized melodrama.
Like the Latin American telenovela market?
Exactly. They are stepping into a pre-existing cultural appetite, but offering a completely novel aesthetic and production value.
Which brings us to the underlying engine making all of this possible.
Yes.
And frankly, the most critical takeaway from this entire call.
The AI piece.
Yeah. Over the last year, every tech and media company has thrown the acronym AI into their earnings reports to artificially inflate their stock price.
Oh, constantly.
It is usually vaporware, right? Just a branded wrapper over a generic large language model.
Yeah, just trying to get a bump in the news cycle.
But the detailed rollout of iQIYI's proprietary AI production platform, Noto Pro, suggests they have moved past the buzzword phase.
They really have.
AI is actually functioning as a core operational tool right now.
Yeah, it is functioning as a structural shift in their unit economics, not just a gimmick for the marketing department.
Right.
Management reported that since opening Noto Pro to creators in April, they already have over 10,000 active users on the platform.
10,000. That's huge. We need to dissect how Noto Pro actually works, because the transcript makes it clear this isn't just a chatbot where a writer types, "Give me a script about a Ming Dynasty detective," and hits enter.
Right.
Management refers to it as a studio-grade platform.
Yes.
How does an AI transition from generating text to actually operating a studio?
Well, to understand the mechanism, you have to consider the historical bottlenecks of long-form video production.
Okay.
An immense amount of time and capital is tied up in pre-production.
Right.
Script evaluation, storyboarding, set design, and shot planning.
The expensive part before you even roll cameras.
Exactly. Noto Pro digitizes that workflow.
Wow.
iQIYI has taken years of internal proprietary data on what makes a show successful. Pacing curves, dialogue density, viewer retention drop-off points.
Oh, wow.
And they've trained AI agents on those specific parameters.
Wait, so if a creator uploads a script to Noto Pro, the AI agent isn't just spell checking it.
No, not at all.
It is performing a predictive sentiment analysis.
Yes.
It can flag that the narrative pacing drags in the third act based on historical viewer data.
Exactly.
Or it can automatically generate a visual storyboard, mapping out the camera angles and lighting setups before a single camera is rented.
That pre-visualization capability is where the capital efficiency is truly realized.
Right.
Historically, the barrier to entry in premium television is the massive upfront cost.
Millions of dollars.
A studio gambles tens of millions of dollars on a slate of pilots. If they fail to find an audience, the operating margins are decimated.
Yeah.
The cycle is slow, it's artisanal, and it's incredibly risky.
Right.
Noto Pro structurally lowers that cost and drastically accelerates the timeline from script to screen.
Management stated explicitly that AI is breaking down the historic barriers of time and cost.
Yeah.
They launched over 3 AI-generated microdramas in Q1 alone.
In a single quarter.
The implication here is staggering.
It is.
They're transitioning from the traditional artisanal craft model of Hollywood to an optimized industrial factory model.
Exactly. Yeah. By lowering the cost of production, they lower the break-even point for every piece of content.
Right.
If a 20-episode drama costs a fraction of its historical budget to produce, the platform's overall margins naturally expand.
Wow.
Furthermore, it allows them to increase their volume of output dramatically.
They can take more swings at the bat.
Yes. They can greenlight 100 projects, let the market dictate which ones resonate, and quickly iterate on the winners.
That makes so much sense.
And by opening Noto Pro to 10,000 external creators, they are decentralizing the creative risk. They provide the highly efficient tools, external creators bring the ideas and labor, and iQIYI owns the distribution pipeline and shares in the upside.
They have effectively outsourced the risk of failure while capturing the mechanics of success.
Spot on.
The efficiency of that model is undeniable, but it encounters a massive external variable.
Right.
You can produce the most cost-efficient, high-quality content on the planet, but if the intellectual property isn't protected, the model collapses.
Yeah, piracy is a huge issue.
Especially in emerging markets, piracy has historically been the primary competitor to premium subscriptions.
Absolutely.
Why pay for a 4.2 billion RMB membership funnel when you can stream it for free on a gray market site?
And that is where we see a critical macro tailwind outlined in the transcript. The Chinese government, specifically the National Radio and Television Administration, or NRTA, has initiated an intense, targeted campaign to eradicate pirated distribution.
The operational metrics of this crackdown are what caught my attention.
Yeah, they're impressive.
The transcript details a mandate where illegal streams of new hit shows are being identified and taken down within 4 to 24 hours of broadcast.
That speed is incredible.
The 4-hour turnaround is an operational lifetime in the piracy ecosystem.
Right.
How does a regulatory body or a company actually achieve a takedown window that tight across the open internet?
Well, it requires a rapid response network that integrates digital fingerprinting directly with enforcement mechanisms.
Okay.
When iQIYI broadcasts a new episode, the file is embedded with invisible, traceable digital watermarks.
Wow.
Simultaneously, AI-driven web crawlers are constantly scanning forums, cloud storage links, and streaming aggregators.
Wait, so the moment a pirated copy is uploaded, the crawler identifies the watermark, verifies the copyright infringement, and automatically triggers a takedown notice.
Yeah. Exactly.
That's insane.
And because the NRTA is actively backing this, those notices carry immediate regulatory weight with internet service providers and hosting platforms.
Right.
The pipeline between the copyright holder and the enforcement agency has essentially been automated.
The conversion mechanics of that 4-hour window are fascinating.
Yeah.
Think about it. If a highly anticipated C-drama premieres at 8:00 p.m., the piracy networks might have a ripped copy online by 9:00 p.m.
Sure.
But if the enforcement network kills that link by midnight, what happens to the consumer?
They're stuck.
They're bombarded with social media marketing. Their friends are discussing the plot twists. They try to access the illegal stream the next morning, and the domain is dead.
Right. The friction of piracy becomes higher than the cost of a subscription.
Yeah.
The gray market consumer is essentially forced into the paid funnel if they want to participate in the cultural conversation.
Right.
By effectively neutralizing the supply of stolen content during the critical premiere window, the state apparatus is artificially protecting iQIYI's pricing power.
It acts as a massive catalyst for driving that core membership revenue growth we discussed earlier.
Exactly.
So we have established the mechanics of their current quarter. Falling production costs through AI, aggressive international expansion, and an enforced moat around their IP.
Right.
But looking ahead, management provided specific guidance for the remainder of 2026 that signals a major pivot in what actual formats they're prioritizing.
Yes.
They're heavily emphasizing short-form dramas.
The guidance is really aggressive here.
Yeah.
They are projecting the launch of over 100 short-form dramas in the coming year alone.
Over 100. To clarify the format, these are highly serialized narratives, typically broken into 15 to 25-minute episodes.
Right.
It is a direct response to shrinking global attention spans.
Yeah, it adapts the viewing experience to the reality of the modern consumer.
Right.
You know, someone who might be watching on a mobile device during a commute rather than sitting in front of a television for an uninterrupted hour.
But isn't there a risk of brand dilution here?
How so?
If iQIYI is known for premium, high-budget historical epics, does flooding the platform with 100 short-form series risk turning their premium app into a localized version of TikTok?
I see what you mean. But the distinction lies in the production value.
Okay.
These are not user-generated clips. They are professionally scripted, cast, and shot, but optimized for brevity.
Right.
And crucially, this format perfectly aligns with the capabilities of Nato Pro.
Oh.
A 15-minute episode requires less shooting time, smaller sets, and fewer visual effects. The capital barriers are significantly lower.
Okay.
They can leverage AI to generate a script, utilize digital sets, shoot an entire season in a matter of weeks, and push it to the platform.
It maximizes the velocity of their capital.
Exactly.
They are not tying up cash in a 2-year production cycle for a massive prestige show.
No.
They are iterating rapidly, finding immediate cash flow, and moving on to the next project.
And their monetization strategy extends beyond the screen entirely.
Yes, this was super interesting.
The transcript detailed a fascinating expansion into offline physical spaces, specifically the iQIYI Land initiative.
They noted the successful launch of their first immersive offline experience in Yangzhou, with further guidance indicating active development of new physical locations in Kaifeng and Beijing.
Right.
Taking a digital streaming business and moving it to commercial real estate and theme park operations is a massive pivot.
It is, but it's a deliberate application of the legacy Disney playbook.
Okay.
You utilize the streaming platform as the marketing engine. You build deep emotional attachment to the intellectual property on screen, and once that brand loyalty is established, you monetize it in the physical world.
Right.
A subscriber might pay 30 RMB a month for the app, but a family visiting iQIYI Land is paying for tickets, food, and merchandise.
Management explicitly noted that their in-house merchandising operations just hit a new sales record.
See.
The life cycle of the IP is drastically extended.
Exactly.
A hit show doesn't just generate revenue for the 3 weeks, it trends on the homepage. It creates an annuity stream of revenue when fans buy tickets to the immersive experience 6 months later.
The lifetime value of the customer expands exponentially.
Wow.
They are building a diversified ecosystem where the digital content feeds the physical experiences and the physical experiences reinforce the cultural relevance of the digital content.
Amidst all this operational expansion, management dedicated a significant portion of the call to corporate financial housekeeping.
Yes, the financials.
The maneuvers they executed in Q1 require a bit of translation, as they signal how the executive team views their own valuation.
Very important for retail investors to catch this.
They announced the repurchase of their 6.5% convertible senior notes due in 2028.
Right.
They also executed a buyback of $8 million worth of American Depository Shares, or ADSs, as part of a newly authorized $100 million repurchase program.
Yep.
Furthermore, they are actively pushing for a proposed dual primary listing on the main board of the Hong Kong Stock Exchange.
So, to unpack the significance of these moves, we must evaluate them in the context of the slight operating loss they reported.
Okay.
A company running at a negative 2% margin is choosing to deploy significant capital toward debt retirement and stock buybacks rather than hoarding cash.
Let's start with the convertible notes.
Sure.
Because a convertible senior note is essentially corporate debt that the bondholder has the option to convert into equity shares of the company at a predetermined price.
Exactly.
If the stock price skyrockets, the bondholder converts, effectively diluting the ownership stake of all existing shareholders.
Right. Your slice of the pie gets smaller. By repurchasing those notes early, prior to their 2028 maturity, management is simultaneously cleaning up the liability side of their balance sheet and eliminating the overhang of future dilution.
They are protecting the equity value for current shareholders.
Exactly.
And the $8 million ADS buyback amplifies that signal.
It really does.
An ADS allows U.S. investors to hold shares in a foreign company. When a management team authorizes a $100 million buyback program and immediately begins executing it, it is a very transparent message to the market.
It is an aggressive display of confidence.
Right.
Management is utilizing their own capital to communicate to Wall Street that they believe the current market valuation fundamentally misunderstands the structural improvements occurring within the company.
They are buying their own stock because they believe it is mispriced.
Precisely.
The Hong Kong Stock Exchange listing proposal operates on a similar wavelength of long-term stabilization.
Yeah.
Holding a sole U.S. listing via ADS exposes a Chinese technology company to immense geopolitical risk.
Huge risk.
Including the ongoing threat of forced delisting due to regulatory disputes between the SEC and Chinese auditing authorities.
Right. A dual primary listing in Hong Kong serves multiple strategic purposes.
Okay.
Primarily, it acts as a geopolitical hedge, ensuring the company maintains access to public capital markets regardless of U.S. regulatory actions. Secondly, it opens their equity to mainland and regional institutional investors.
Investors who inherently understand the cultural footprint of C-dramas.
Exactly.
And the true value of iQIYI land in Yangzhou, as opposed to a Wall Street analyst evaluating the company purely through a spreadsheet in New York.
It aligns their capital base with their consumer base, which is vital for long-term stability.
So we have dissected the revenue data. We've explored the structural advantages of NATO Pro.
We've mapped the international growth.
And unpacked the corporate finance maneuvers.
Right.
Bringing all these threads together requires a verdict.
It does.
Looking at the entirety of the Q1 transcript, are the underlying indicators pointing toward a bullish or bearish thesis for the long-term retail investor?
Interpreting these signals requires separating the temporary noise from the structural reality.
Right.
I hold a cautiously bullish stance for the long term.
Okay.
The sequential revenue dip and the negative 2% operating margin are undeniable short-term headwinds.
They are.
The loss of distribution revenue requires a transition period. However, the core mechanics of the company are undergoing a highly positive, permanent transformation.
Right.
NATO Pro is not theoretical. It is actively lowering their production costs and expanding their output capacity today.
Yes.
Their C-dramas are demonstrating viral, highly monetizable traction in regions completely outside their historical footprint, like Brazil and Mexico.
They have proven they possess a scalable cultural export that does not rely on massive, bloated Hollywood budgets.
Exactly. The temporary financial drag they are experiencing is the necessary cost of retooling their infrastructure.
Right.
They are building a significantly more resilient, globally efficient engine.
The actionable takeaway for anyone analyzing iQIYI is that the thesis has evolved.
It really has.
You are no longer evaluating a regional distributor attempting to monopolize a single domestic market.
No.
If you're holding or considering the stock, a position in this company is a bet on their capability to deploy proprietary AI tools to permanently depress production costs.
Right.
While simultaneously utilizing hyper-localized, culturally distinct content to capture emerging international markets.
It is a bet on the successful transition from a geographically constrained platform to an automated, borderless studio system.
Which leaves us with a final provocative thought to consider as you review the shifting landscape of your own portfolios.
Yeah.
We began this discussion by examining the old geographical map of global media, a map historically drawn and dominated by Western studios.
A map that relied on massive capital barriers to prevent competition.
Right. If a regional streaming platform can successfully train AI agents to drastically lower the cost of production, instantly localize that content across multiple languages, and achieve over 100% year-over-year growth in a market as culturally and geographically distant as Latin America.
Yeah.
Are the legacy Hollywood streaming giants already structurally behind in the global content war?
It's a great question. The advantage is shifting rapidly from the institutions holding the most legacy capital to the platforms operating with the highest technological agility.
The borders of the media landscape have already dissolved. Some of the biggest players on the map simply haven't realized it yet.
Very true.
Thank you for joining us as we unpack the transcript. Keep questioning the consensus, and we will catch you on the next deep dive.